In this segment, we're going to talk about working capital management. Well, working capital is our current assets minus our current liabilities, right? So we've got inventory in there, we've got our short-term debt in there, we've got our cash and cash equivalents in there, we've got our payables in there. So the management of all this short-term stuff is what we want to look at here. So cash management, and also how to evaluate the working capital management of a firm. So let's start looking at sources of liquidity. Our primary sources are cash, cash equivalents, collections on our accounts receivable, and any investment income that we have. We could have trade credit, right, our payables from purchasing supplies from our suppliers and paying them later, buying on credit. We can have bank lines of credit and short-term investment portfolios as a source of liquidity. Now, these are all normal operations. Secondary sources, ones that might significantly change the firm, are renegotiate our debt, liquidate some assets, or go through bankruptcy proceedings. So what are the factors that will influence the liquidity of the firm? Well, one, the effectiveness of our cash management. And we'll look at a couple of items to look at. We've got to see that we're investing our cash correctly. When we have excess cash, we're putting it somewhere where it's going to generate some interest. Okay? When we have needs of cash, we employ short-term financing sources that are efficient. Centralization of collections, that is, as the bills are paid and the money comes in, if it comes into a centralized collection spot at a bank, then that's going to give us better liquidity. And the liquidity of both our short-term and long-term assets are going to influence the overall liquidity of the firm. Now, there's some ratios that we use, and these you've seen before. You've seen the current ratio before and the quick ratio. With the quick ratio, what did we do? We took out inventories. And then our cash ratio is our cash and short-term securities. Short-term securities being like treasury bills with maturities longer than 90 days, so we don't include them in cash and cash equivalents, but short enough that they're very liquid and very low risk. So there's three of our liquidity ratios there. We can also look at receivables turnover. Remember, that's sales over receivables. Our inventory turnover, cost of goods sold over our average inventory. Or our payables turnover, purchases over average trade payables. And note that in these, to help you remember them, that they have to be consistent. Our receivables are measured in retail dollars if we're selling retail, or I guess customer prices might be a better way to say that. And so are sales. Average inventory is measured at our costs of production, and so that's why we want to use costs of goods sold in the numerator. And our trade payables are based on prices we paid to our suppliers, so we want to use purchases in the numerator there. Now, if we divide these, receivables, inventory, or payables turnover, into a 365-day year, we get number of days of receivables, inventory, and payables. So it's our average number of days worth. So here, for receivables, it's the average number of days of credit sales that we have outstanding. I guess we use sales here. We'll get the average days of sales outstanding. It can also be calculated with credit sales, in which case this would be the number of days of credit sales outstanding, average days credit sales. So notice when the receivables turnover goes up, we're collecting more rapidly on our accounts receivable, then the number of days of receivables goes down. Now let's talk about our operating and cash conversion cycles. Our operating cycle is number of days that things spend in inventory on average, plus the number of days of receivables. Now remember, if we're a manufacturer, raw materials hit inventory as raw materials. Then they stay in inventory as they're processed through to finished goods, and they stay in inventory until they're sold. Assuming they're sold on credit, then there's a number of days from when we sell it until we eventually collect the cash. So that's why we call this our operating cycle. Start with raw materials, end with the cash from the sales. Now when we talk about our cash conversion cycles, we make an adjustment to this for the number of days of payables. Because if we order our raw materials on this day, we don't really have to pay for them that day if we buy them on credit. We're going to pay for them some days later on average, and that's where we're going to use this days payable. So this cash conversion cycle is sometimes called the net operating cycle as opposed to just the operating cycle. Take a look at this with some arrows. We start with raw materials, we buy them right here. And then they make their way through inventory to finished goods and finally get sold on credit right here. And then there's the average number of days until we collect the money on our credit sales. So that's our operating cycle. Now, if we don't pay for the raw materials here, we buy them on credit and on average pay for them this many days later, then this is where we coughed up the cash, and this is where we got our cash back, collection on our receivables. So that's why we call this the cash conversion cycle. And as you can see, the longer we stretch out paying our suppliers, the shorter the cash conversion cycle. The more rapidly we collect our receivables, the shorter the cash conversion cycle. Now what do we do with our daily net cash? Well, we've got to decide if we've got excess cash, if we're going to need to borrow. In this case, if we have excess cash, we'll invest it in short-term securities. And some of the things we'll invest in are U.S. Treasury bills, short-term federal agency securities, bank certificates of deposits, bankers' acceptances, time deposits, repurchase agreements, commercial paper, money market mutual funds, or adjustable rate preferred stock. It's preferred stock where the rate is adjusted periodically to the market rate to bring the market price of the preferred back to a target level. Now, how do we compare the short-term yields on these various instruments? Because some of them, bankers' acceptances and treasury bills, are pure discount instruments. Others pay explicit interest. So how do we compare them? And how do we compare their yields? Well, we've got various kinds of short-term yields. This one you've seen before in quant. That's the percentage discount. And then the bank discount yield was that percentage discount from face value. This is what we use to quote the yield on treasury bills, annualized by multiplying times 360 over the number of days until maturity. So that's our discount basis or bank discount yield. It's not really a discount though. Excuse me. It really is a discount. It's not really a yield. If we want a money market yield, we take the difference between the face value and the price and divide it by the price we paid. So that's a real holding period yield right there. There's our HPY, holding period yield. And then we annualize that, same as we did with the discount, multiplying by 360 over the number of days to maturity. So that's the holding period yield times 360 over days to maturity. Now we defined a bond equivalent yield differently in quant, and we define it differently in fixed income. So note that this bond equivalent yield is for short-term securities. And we're taking face value minus price over price. Well, that's our holding period yield again. and we're just annualizing it. Still, simple annualization, it's not an effective yield. Simple annualization with 365 over the number of days to maturity. And that's our bond equivalent yield. And the suggestion in the CFA text on this is that if we have various instruments quoted different ways, that we should put them all on a bond equivalent yield basis. And we can do that by getting to their holding period yield and multiplying times 365 over the number of days. If we put them all on the same basis, then we can compare the yields and decide which are the best choices for our cash management strategy. Now, for our cash management strategy, we have an investment policy statement, which should spell out, and this is just a general outline, the purpose and objectives of the investment portfolio, what we're trying to achieve, and then some guidelines on strategy based on what we're trying to achieve, and what types of securities are allowable, and who is responsible, who's allowed to buy and sell for this portfolio. And if we end up with problems, wrong types of securities, wrong individuals have done something, how do we take corrective steps? And what are the limitations on what people can do managing this portfolio? Another tool for evaluating how we're managing our working capital is to look at our accounts receivable, and here we have an aging schedule. The important thing here is you just understand what you're looking at. It's in thousands, and it tells us of our outstanding, of all our accounts receivable, how much of that is less than 30 days? 200,000 in March, and we can see the progression over time. Accounts receivable between 31 and 60 days, 150,000, 61 to 90 days, 100,000, and greater than 90 days, 50. This can also be presented as a percentage of total receivables. So you could see the percentage in each category, and you could look across time and see if that greater than 90-day number was creeping up on you or other significant changes that you should be aware of. Now here we have another way of looking at this called the weighted average collection period. So here, of all our outstanding accounts receivable that are less than 31 days old, what's the average number of days? 22. Of those accounts receivable that have been outstanding between 31 and 60 days, what's the average number of days they've been outstanding? 41, excuse me, I can't read. 44 here. So once we get those average days for each category, then we can multiply them times the percentage of the total accounts receivable that are in each category. Multiply all those together and come up with a weighted average collection period. Now, as with any summary measure, we've lost a lot of information, but the other side is we've distilled it down to a single number. So we can look and track that single number over time. If it moves too much and in a direction we don't like, okay, that is longer, if it grows significantly, then that's something we'd want to take a look at and then look deeper into some of these other schedules. So in terms of evaluating performance, our receivables, we've got a trade-off between credit terms and sales. The more liberal our credit terms, the more people buy from us. If we don't collect at all, I think everybody'd buy from us. Inventories are also a trade-off. If we have too little inventory, it can lead to stockouts. We can't meet customer orders, they go somewhere else. If we have too high an inventory, well, inventory has costs, right? Instead of cash or short-term invested cash generating interest, we've got monies tied up in inventories. So too high inventories means we've got too much tied up there. We're not managing our working capital well. So it's a real trade-off there. High inventories, you're wasting money. Low inventories, you're losing sales. Somewhere in there is an optimal inventory level. In terms of payables, often payables will come in and give you a discount, like say 1% if you pay in the first 15 days or something like that. And so early payment, we can take advantage of these discounts, but if we give up the cash and pay it early, we're giving up potential interest on that cash. Later payment increases our interest costs, and it can damage supplier relationships as well. I mean, one way to raise money in the short term is to just stop paying your bills. But what we're saying is there's cost to that and also limits to that in terms of what your suppliers will put up with and how it might damage your relationship. So we talked about investing short-term funds. What about if we need money in the short term? Say we've got a seasonal business. We've really got to build up our inventories going into September and October to sell through for the holiday season. Well, one source is a line of credit. The committed line of credit requires a fee because the bank is saying, or whatever company it is, but usually a bank, is saying, we're committed. You've got $2 million here. You can draw on that anytime you want. And this can even be a revolving. That is, you can take it up and you can pay it back down. This will have a fee, and it's granted to the largest and strongest credits in the U.S. An uncommitted line of credit is less reliable and has no fee. Less reliable in the sense that you say, well, we've got $1 million uncommitted line of credit, and you go to tap it because you're short of money, and they go, well, you don't look like you did before. You're short of money. We're not going to lend it to you. So certainly less reliable. Excuse me. Bankers' acceptances arise from import and export. It's basically a bank's guarantee to make a payment so many days in the future. So it's like a pure discount note. It's like saying, this bank will pay $200,000 on such and such a date. And so those are sold at a discount. So if you're buying them, then you buy them at a discount and you get the face value. Here, this would be a source of funding if we were an exporting company. Factoring is for smaller users and has higher fees. Typically, we'll take our accounts receivable and pledge them as collateral against a loan. Commercial paper, very short-term paper. Well, I won't say very short-term. Shorter than 272 days because debt securities issued with maturities of less than 272 days don't have to be registered with securities regulators in the U.S. So a lot of companies will use this instead of using banks and borrowing from them as intermediaries. They'll issue this commercial paper anywhere from 2 to 272 days. And again, it's pure discount. Sold at a discount, matures at its face value. And the largest, strongest firms can issue their own commercial paper and lower their costs of funds that way. There are also non-bank finance companies and companies with weak credit that the banks aren't going to lend to on any kind of terms they can stand might seek out non-bank finance companies. But this is going to be a higher cost of financing and perhaps more restrictions on the actions of the firm to protect the creditors. So let's take a look at a cash management problem here just to wrap this up. Firm A's operating cycle is 38 days. Firm B's operating cycle is longer, 42 days. But its cash conversion cycle is shorter than that of Firm A. We can conclude that which of these three? Firm A has better inventory management, Firm B has better receivables management, or Firm B has lower payables turnover. Give you a second on this. What could it be? Well, I think we like answer C here. Firm B has lower payables turnover. Remember, lower payables turnover means more days payables. Now the difference between the operating cycle and the cash conversion cycle was with the cash conversion cycle we subtracted off days payables. So firm B's operating cycle is longer but its cash conversion cycle is shorter. It must have a longer days payables by at least the difference here of 4 days. So it's got longer days payables, so what does that mean? It's got a lower payables turnover. So don't be surprised if you see questions on the exam that aren't as straightforward as you might think. They'll cause you to think and bring in your understanding and comprehension of various concepts all into one multiple choice question.